Welcome to Drunken Fedora. My name is Lotte Leibner and I'm going to show you today the numbers behind this business. So the Drunken Fedora is a bar that offers guided drinking hikes. Our hikes are group hikes and they start at the bar, and along the way you are going to have a couple of drinks. The hike stops then at various checkpoints and there you drink. One hike is about 1 hour and they start every 2 hours. It costs 20 euros per person and it includes 3 drinks, beer, cider, or Lonkerer. Then the bar where it starts, we also sell hot and cold sandwiches, of course various cocktails, and also merchandise, which are shot glasses and patches. Here you can see the opening hours depending on the season, and Mondays are always closed. Then we go on to the products. We have the sandwiches on top, cheese and chocolate sandwich. We came up with the price of the ingredients, how much we need, and then how much that would make per sandwich. Calculated that for all the ingredients and have that here. Then we have sales price, 14% VAT, and that results in this sales price without VAT and this gross profit for us. Same we did for the chocolate sandwich, and then we calculate the average price for us per sandwich and the average sales price without VAT, as we need them later. We did the same for the drinks. We have the ingredients, the price, the amount, calculated what that would cost, what the costs are for us, sales price, VAT, sales price without VAT being calculated, and the gross profit. And again, we put the summary of the average drink for the price we pay and for the average price without VAT. We buy our drinks for the hike for 6 euros as they're included in the price. We don't need anything else here. And then we have the patches and shot glasses we sell. We buy them for 2 euros. We sell them for 3. VAT is 24%. Sales price without VAT has been calculated here, and our gross profit. Let's go on to the customers. On top, we made up our customer base, what it could look like. We start with a hiking number of hikers of 450 in April, January to March are closed. And then we came up with some growth or decrease in the winter and calculated then how many customers we have per month. Same for the bar customers. And then we have here a list of what the hikers are spending. We have the winter people who buy patches in winter. Yes, so winter and summer patches, and then the price we get out of them, the money, and they're being calculated here. The same for the shots. Also all the way, the sandwich, 50% of our customers are going to eat sandwiches, also makes up the price here. Tickets, of course, everyone who is hiking needs to buy a ticket. And then we have cocktails, which also every of the hikers is drinking an average 1 cocktail. So we have that here. And then the pure bar customers, 70% of them are going to drink something. Then the average price per cocktail, 40% of them are going to buy a sandwich, and that also is the same here. All the way it's the same. And then the turnover is just a calculation of all our income. Variable costs are coming on the next page, and then we calculated those together and have the actual money that we get out of these sales purely. For the costs, we have variable sales, nothing in the first 3 months. In April, it starts then with the hiking drinks. So we calculated the what we get from the products, the average price, and then by the number of customers. And we do that all the way along for all the months and for all the products. It's all the same. And then we calculate all of them together and have our average variable cost per month. And then we have the fixed costs. There we have first the operating costs, rent, insurance, and those things. The price here is already per month. We still calculated them per year in case we ever needed it. Yeah, and then we summed it all up. Oh, here I pressed now something wrong. No, all good again. All right. And then the equipment, and there we said how many of, for example, tables we need. One table costs 80 euros. It would be good for 5 years. So our monthly payment for those tables, our yearly payment for those tables would be this, and our monthly payment, so we can easier divide how much those tables are worth each month. We have calculated here, summed it all up down here. Yes, and then we continue with the staff costs. We need an extra sheet as there's a bit more. So here we have the opening hours. We always added 1 hour more to have the bar, like the barkeeper working half an hour before and after the bar actually opens, so to prepare everything. So these end up in here, times 3 because it's Tuesday to Thursday, and times 4 because 4 weeks per month average. Then we have the amount of drinks and the amount of sandwiches summed up here to have easier access, and then we calculate the time we spend on making drinks and sandwiches. So it's 3 minutes each, times the number of drinks and sandwiches we have, divided by 60 to have an actual number of hours. Results in 44 hours in April, for example. And as that is shorter than the time the bar is open, we have the if function that the barkeeper will be there 204 hours. Yeah. For the guide, we have calculated here the hours, so it's just that. Yes. And then the amount of money they get, we have their hours times the salary. And now to the big sheet. So on top, we have our total sales, which comes from customer. We've seen that earlier. Our variable costs, we have seen that in the cost sheet. The fixed costs divided in the equipment, operating costs, staff costs, they're all pretty much just copied from other pages, just that we made them negative by adding this times -1, so we can just sum it up in here and see the resulting amount. Then in here we also calculated the VAT from the sales, so we have the VAT 24% from the total sales, and the receivable ones from the operating costs. And then we have the cash flow, now the more interesting part. So sales are normal, as we just have private customers. They are just paying whenever they are at the bar. Same with the VAT. However, we take a loan in the beginning of 13,000, which we have here down here. I get to that later. And we pay a share capital of 10,000. So that just is the result of this table. And then the outgoing cash flow. So the material, like the drinks and the ingredients for the food, we buy each month, so that's where it comes from the costs. Operating costs already start in January, as we already have to pay rent then. VAT for the operating costs we have here. We have the fixed costs also, This time they are all in January, as we need to buy the tables and all the equipment already in the first month to build up the bar before the customers come. So that's when we pay those. We have the VAT of that as well. And then we have the staff. They start working in April. We have the employee tax, but we don't need to pay it, so it's empty. And we have the loan payment, which we have calculated down here. So we have 13,000 loan. We want to pay it back in 1 year, which are 12 monthly payments. Interest rate of 3, monthly interest rate of 0.25 results in this. Yes. And that was the loan. Okay, so the outgoing cash flow summed up to have all that needs to be paid each month. And then we have our total result per month. So it's the incoming cash flow minus the outgoing cash flow. And this is like what we have in our bank account. So it's like the month before plus what's happening in that month. Yeah, it looks good in this example. So I guess we should go ahead and start the business. Thank you.